Business of Property podcast. I'm Simon.
And I'm Simon.
I've been investing in property for over 20 years, and if you're an active landlord or planning your next property investment, this podcast is for you. Simon Glastonbury is an independent mortgage broker with 25 years of experience providing mortgages, bridging, and development finance for home buyers and investors. If you're able to leave a rating or review in your podcast player of choice, whether that's Apple, Spotify, maybe YouTube, or something else, then I would very much appreciate that. Now, with Simon joining us today, I'm very pleased to say that we are, at the end of this episode, going to have a sort of normal rundown of current mortgage rates for buy-to-let and HMOs and sort of the common situations. Before that, though, we are going to have a little bit of an overview and introduction to bridging finance and what that is and how that sort of can be used in the real world. But before any of that, we are going to start with the big news, which is that the Bank of England has reduced the base rate. Woohoo! And now, with the bank rate reducing, obviously that means that all our problems are solved, Simon, doesn't it?
Great introduction, Simon, as always, and great to be back. Yes, of course it does. everything in the world is okay again. Unfortunately not. It hasn't. I mean, the good thing is, and we finished at our last meeting, saying, and I think I said I wasn't expecting a reduction in August. I think it will be September. So again, don't listen to what I've got to say.
Well, in the future forecasting area, do listen in other areas.
We were close. I'll take that. Very kind
indeed.
But we have been expecting that reduction for a while, and it is good news. It's good news across the board. It really, really is. It certainly it shook up the market a bit. It's the first thing that's happened for me and my team straight away, and I would imagine it's happened to every broker across the land, is we were inundated with calls and emails from new clients, existing clients, saying, "Oh, rates are coming down. Can I jump on a lower rate?" Unfortunately, that hasn't quite happened yet. We're still very fresh. It's just happened. And I would say to everybody, it does normally take a couple of weeks minimum for banks to work out what they're doing, their existing products, what they can do, how much money they're going to put into new products, and then price them in. So yes, they were probably expecting that. Yes, they've got this in place, and they will know what their fixed rates are going to be and when they're going to launch them. But they can't do that straight away. They've got their systems in place. So although we want it to happen and we want them to drop straight away, it's not happening. So the good news is, as we speak, a couple of the larger lenders have dropped rates. Of course, that doesn't, and I'm talking about rates, I'm talking about fixed rates. Tracker rates virtually instantly would drop down, and their variable rates would drop down pretty much in line with base rates. So that's great news. And that's got to be good news for the market. It's got to be good news for the property market. It certainly is from people I've spoken to already. Things are happening. People are a little bit more excited. And I think we need that just as a country, really. We need that. We've been talking about it for what seems like forever. And we just need a bit of good news. And that is the good news. Something we were speaking, and we're looking at every day, to be fair. So what's happening with base rate now? What's happening? And I'll go back. I'll go through the rates as we normally do at the end, so people will know, listeners will know exactly what's going on with the rates at the moment. Haven't changed an awful lot, so we're not getting too excited, but watch this space. I do think that will change over the coming weeks. So if anybody's out there looking, look now, but don't. I would certainly expect fixed rates to change enough to make a significant difference over the coming week. So, which is just great news. That's exactly what we wanted to do. Another teaser: there are some sub 4% rates out there in the residential market now. So, yes, we get there slowly but surely. So yeah, that's really
Indeed.
good. And it's now a case of, right, okay, well, what's going to happen then? What's going to happen in the marketplace? The general feeling with base rate going forward is that they are still going to fall. I have an ear to the ground, an informer, shall we say, within the marketplace, as just this morning has turned around and said there'll be a 0.5% cut by Christmas, and there'll be a further 0.5% cut by this time next year. That's brave, I think. That's
Yeah, I
really,
agree.
really brave. I don't think personally I can't see that because Bank of England have been so cagey with cutting rates up to this point. They've been really, really slow, and it's only 0.25%. So
And I think there was only one vote in it, wasn't there,
yeah,
on the policy
two,
this
I
time around?
believe.
Or was it
Was
two?
it
Was it?
two? Yeah,
Okay.
I believe two.
But it
Yeah,
was close anyway.
yeah, it was very close. But either way, I mean, whatever the discussions were and however it's worked, it is going to be close. It's been close up to this point. Can't see it. I can't see it. If we have another a rate cut, possibly 0.25% by the end of the year, I think we'd all be very happy with that. I think. And if we are then looking at another 0.25% first half of next year, I think we'd all be over the moon. Because it would really would kickstart the property market, the buying market. It's, we know, and we spoke before, having a real problem with first-time buyers. First-time buyers are really, really nervous. Investors are looking and going, the rates just aren't good enough. The fees are far too high. The prices are not realistic. So maybe by that time, things will, so with rates coming down, fees hopefully following, and then property prices not remaining a little bit stagnant, hopefully coming down when you're looking to buy. But it's all about demand, isn't it?
Yeah, yeah. In the housing market, I'm still seeing a lot of reductions. Certainly in the southeast, the area that I generally look in. So yeah, I think it's going to take a little while before it actually sort of filters through to the buying intentions, at least en masse. I mean, hopefully the slight reduction has sort of changed the sentiment, the sort of way people are approaching things. But yes, I think it's going to be a little while longer before we actually see that in house sales and certainly in prices. So,
Yeah.
yeah.
100%. I think that's the thing. But I think anything we've had such a sort of torrid time where we think we perceive that rates have been very high when in actual fact historically they haven't. If we've had or anybody's had mortgages pre-crash, sort of 2008, 2009, rates have actually been really competitive. But of course, that's a long time ago now. And lots of people, there's lots and lots of first-time buyers, never experienced rates like this before. It's very painful. It's hurt them. Cost of living crisis is hitting everybody. We know what the cost of everything is. It's very different to that time. So this is welcome. And I think it will be. And we still are a society who likes to move house. The younger you are, certainly. We're very much stuck in that tradition of buying your first flat, buying your first 2-bedroom property, buying your first family home, moving up through the ranks through that family home. That's what the society does, and we want to do that. So, but that's stagnant at the moment. People are not doing that. Yes, they're putting extensions on and they're redecorating and things. But everybody knows that it's sort of a plaster. It's just kicking the can down the road at the end of the day. What they want to do is move. Because aspiration, whatever the reason, growing families, change of area, better schools, whatever it may be, people want to do that. And it hasn't happened on a large scale. I mean, I'd imagine government are feeling that as well on the stamp duty side. They make billions out of stamp duty. If property is not moving, they're not making any money. So that's also going to be an issue. So there's got to be a kick. So I think great news. The markets are telling us they're already priced in with some serious base rate drops. let's say if let's hope, keep fingers crossed that does happen. I would personally welcome a 0.25% drop by Christmas. If that happens again, I think that will really, really help all of us in the market, buyers, sellers, advisors alike. And we'll have a little smile on our face at Christmas.
Indeed. Something to look forward to, hopefully.
Absolutely.
Yeah. Just picking up on what you're saying about people just not moving very much at the moment, I think it's interesting that that's also happening in the rental market as well. There's a lot less fluidity in terms of sort of people moving around in rental properties as well. And yeah, I think it's the whole market from sort of when you first leave home into your first rental property and then move around in that, and then, as you say, step up to your first owned property, is that the whole chain is a bit stagnant at the moment, and needs to get going again.
It does, and and also with the rental market, we want to the government is very aware that it's a huge market, and we need landlords. We need good landlords, but we need landlords because it's huge. It's absolute, and that can't get out of control because at the moment, they're on a keel again, an even keel again at the moment, aren't they? Or it seems to me, from what I'm seeing, with people coming out of properties, first-time buyers, and going in, the few we have got. The mortgage is fairly similar, where 4 or 5 years ago they were jumping out of rental properties into their first purchase and saying, "I'm saving £500, £600, £700 a month." That isn't happening at the moment, and what we don't want to again is we don't want the rental market to increase to a level where people just can't afford to rent. Or it's pricing people out the market. So there's a balance there all the time, isn't there? And we've got to keep an eye on, well, the government. They've certainly got to keep an eye on landlords because they're the ones not driving it. They can do what on earth they like with their rental, but they'll only do that with demand. But if they're selling properties back into the first time buyer market, it means there's less rentals. It means rent prices will go up. And I saw that. I think Foxtons were announced this week that London rental market has gone up, or the cost is 14% in the last year or something, which is it's an astronomical amount in such an area. So got to be careful all round, but generally, let's keep positive because it's the first bit of positive news we've had for a while. Base rate is down, and it looks like we've got more coming.
Indeed, right. I won't turn that conversation negative again. So let's draw a line under that one. And let's move on to our next topic. So this is bridging finance. And we thought, we don't talk about bridging finance very often. We're mostly talking about mortgages. But Simon does have a lot of experience in bridging finance as well. So we thought it would just be nice to give a bit of an introduction to it. So first of all, Simon, what is bridging finance, and how is it different from a traditional mortgage that listeners are, I'm sure, are a lot more familiar with?
It's a great topic, and bridging is a really, really popular product, and there are lots and lots of different areas of bridging. You can bridge for all different types of reasons. Traditionally, people would think of bridging for if they were to buy a new house. And for some reason, they couldn't sell theirs or their buyer pulled out. So for a short period of time, they would bridge between the difference and which is basically getting another loan on the house they were going to move into if their previous house was delayed being sold for whatever reason. So it was a stopgap between the two. Now that's developed into a lot more complex cases if needed. But a common one, and certainly a common one with investors mostly, is something which is a property which needs some sort of refurbishment, be it light refurbishment, heavy refurbishment. Light refurbishment, generally kitchen, bathroom, where someone has possibly lived in it for a long time, haven't decorated for the last 20, 30, 40 years, it needs to be rewired, and it's not in a lettable state as it is. So a standard buy-to-let lender would go in and say, well, it's not in a lettable position. The valuer would say, no, we can't lend on it. So they have to refurb. So the best thing to do, or in many cases, is then to bridge that short term. Now, a bridge can last anywhere from a matter of a few months up to mostly normally the longest term is 12 months. There are, in some situations, you can get up to 18 months, depending on the product, who it's with, but we'll be very general here. So something like that, you can go in, it gives the developer then the opportunity to go in and redevelop the property, get a team in now, put a kitchen, a bathroom in, and well as I do, these teams can go in a matter of weeks, possibly a month or two, completely redesign the unit, and it's up for it's ready for a standard buy-to-let mortgage. Now, what some of the bridging companies will do is they'll package that into one, so they will have they will supply the bridge in the beginning, then revalue the property once it's done, and flip over to a buy-to-let product. Absolutely brilliant. Now, depends on what rates, and if you're chasing rates, and if you're looking at market rates, sometimes it's okay. Sometimes the back end buy-to-let is a little bit more expensive, so you might want to look out on the open market, which is absolutely fine. No problem. They will try and entice you in and say, well, you only pay one fee, and to make it a little bit easier. And the process is easier, of course, because you're not changing lender. But it really is. I mean, some of the myths about bridging, people seem to think it will still take a matter of days. Yes, it can. There are, but it's like anything. We can get a mortgage through, or we have done, in a matter of days. But it's very few, very far between. It doesn't take as long as a mortgage. A standard buy-to-let or a standard residential mortgage doesn't take as long, but it's not days, it's weeks. So generally speaking, so just people be prepared with that. It's a bit of a myth. Rates will depend on a number of things. It will depend on your the loan to value. It can depend on experience, depending on which lender you're going with, what you're doing with that property, if it's a light refurb, if it's a heavy refurb. So if you're knocking down walls, you're building extensions, you're building huge extensions into the roof, whatever it case may be. That does depend on what you're pretty looking at. But they can start at sort of 0.5% a month, anything upwards of, if you're paying upwards of 1% a month, it's something really, really tricky that no one else is really touching. On average, 0.65, 0.75 a month is around about where you'll be looking at, I would say, for a bridge, if you're looking at that on a monthly basis. Obviously, you don't want to be paying that for very long. You want to do the work as quickly as possible, switch it out onto a standard residential, standard buy-to-let, whatever you're looking for at the back end. Fees, that again will depend on generally how complicated the property is or the bridge is, and also on the lender. But typically, you're looking at I would say 1 or 2% fee is fairly standard across the mainstream bridges.
You mentioned that it's not quite days, but it is for weeks, and often a traditional mortgage is sort of maybe a month or a bit more. I would think. So, what's the difference in the process, the sort of applications and things do you need to give them different information for a bridge, or is it just that they're faster at making their decisions and being responsive in that way?
Yeah, very much so. I think it's faster in their response. They know for a bridge, it's usually you're usually tight for time. You're working on a much different basis. It's they're generally speaking, you're working very closely, or we are, with an underwriter or with the case manager on the application itself, so you can talk them through. It's a lot of them are standard application based. Most of them are online, as we would deal with them. Some of them, like anything, you can go to a specialist bridger and everything's going to still be paper based even in this day. But they will look at things through. But they're looking at your past experience. They're doing very much the same as they would with your standard mortgage.
So
The
is it the
key,
same sort of information that you have to provide?
absolutely, yeah, absolutely. They're not too concerned. People saying, well, income or whatever is the classic first one, right? Well, what can you look at this? They're not looking at that because it's a very short term finance. The key for most bridges is the exit. That needs to be in place, or they need to know and have assurances that within that, let's say, 12-month period, you are going to be able to refinance or you're going to be able to pay them back. There's very little, one sort of caveat here, there's very little flexibility at the end of a bridge to extend. And I tell pretty much everybody to say, look, if we're setting it up for 12 months, it needs to be repaid within 12 months. The powers that be will come down on those bridging companies who don't have their loans paid back within that time. So it's very important. And then they have to be very careful if, for example, and I've come across it, that you've had something like development finance, very simple. You probably wouldn't call it bridging, but it is bridging. You're still paying generally on a month by month basis. And some developments will go over. Some developments will go over that 12-month period. They need additional planning. They've come across groundworks which they couldn't get up for whatever reason, wildlife problems, any number of things. They can go over that 12-month period, and it may only be slightly and need it extended. Generally, what you would do is then you will move bridger and move company to take that over. Now, the new company have to justify very carefully why they've done that and taken it from another bridger. Yes, it can be done. They don't like doing it. They have to be extremely careful in that sort of scenario. But as long as it's justified, and for something like a developer, well, you're going to sell the property at the end of the day. So just to making sure that they have that exit there. But the key here is, I'd say to anybody, with bridging, it's all about the exit. So if it's something you're developing or you're just refurbing, they know that, they can see the property. It will be valued at bridging stage, so up front, and then it will be valued again, of course, when all the work's done. But going back and circling right back, people are still bridging if they've had their properties fall through, or they've found their dream home, and they haven't found the buyer yet, or the right buyer. Certainly in this market, it can change, because when you do get a buyer, you don't want to lose them. So they feel the same with properties moving forward, because they're not quite the properties on the market at the moment. So certainly, they will. You can use bridging for that. It's not as common at the moment, but also then you go to things like auctions. Auctions are great for for bridging. But there are products out there as well in the mortgage market, and there are lenders who will look at auction properties, because it was always a headache previously. I digress slightly, for going to auction, because you think, well, it's got up for circa £250,000. Is a guide price. It could, and as we know, if you've seen it auction price, that could be, doesn't happen very often, but it could be got for 150. It might go for 350. There's such a broad sort of spectrum of things there, but people do use that on a regular basis, and that's more the serious auction buyer, experienced. You could use that. There would be more checks if you've never done it before. Because what bridgers don't want you to do is get carried away and start bidding away and going well above your price, because if it's not valued at that, you'll have to start putting a lot of your own money in.
Yeah. So just on the auction side of it, obviously a lot of properties at auction are sort of ones that need work or have problems or whatever else. So you may well be in that situation where you're bridging and doing work, but there are also properties at auction that are perfectly good and ready to roll. So in those situations, could you potentially have a bridge sort of just for a month while you're working out your mortgage? That doesn't actually take much longer, but just a little longer.
Yeah, absolutely. You could. I mean, you can do. There are auction products out there where you may be asked, depending on the lender where you're going with it, You may be asked to historically get the property valued before you actually go to auction, which can be a headache because you're bidding on a property you just don't know you're going to win. So that very, very rarely happens now unless you are extremely confident. But something like that, absolutely, you could do that. And if you needed to bridge before you actually get your mortgage on the property, you could do that. You've got to be a little bit careful. I mean, speak to a broker about this. Look at the individual property, look at your circumstances, so the broker can work out what is best for you and someone within that market, because you're going to pay higher fees. I mean, bridging, it's a fantastic product. It really is. The rates are not horrific as they have been historically. There are a lot of new bridges coming into the market, looking at all different areas. They want a slice of that business. They want a slice of that market. So they're trying to be competitive, which is fantastic for us. But it does mean that there are fees in the back. You've still got valuation fees. You've still got legal fees, and then you're going to have this arrangement fee hit on the top of it. You've got to make it worthwhile. But something like a standard slight refurb on a property. Most of the properties you do see now, the experience I see at auctions, are something banks know they can't sell easily. Why would they put it? They're not silly. Why would they put it into an auction? And it could go for who knows what. There's different circumstances, obviously, on every single product, but on every single property. But why would they put it in an auction and just guess what they're going to, unless it was really urgent, and they're not getting anything on the open market. So it's usually something which needs work done on it. And
just picking up on your point about exits and the sort of strict ending of bridging, if that all goes pear-shaped, can bridging lenders repossess properties in the same way that mortgage companies can?
Yes, and it is the simple answer to that, and I will use a strong yes on that one. And it's, unless you really have, if you've ever come into contact with anybody who's had a property repossessed, it's very difficult to get an understanding of how that works and how long it takes. One thing I would say is it takes forever. The lenders are under strict instruction not to repossess properties. They don't want to. It's costly for them. It's a headache for them. It looks very bad for them. Whoever has instructed them, I would imagine the government in some sort have said, do not make people homeless unless it is absolutely necessary. I've had some experience of that over the years, and people have literally not paid their mortgage for years, a number of years, and the bank will say, right, okay, we'll keep you going. There are always reasons, but until they get to the point and the people are in conversation, say, look, I'm never going to be able to pay it because I simply can't. Okay, well, you're going to have to sell, or we will repossess. If it's a buy-to-let property, they're a little bit quicker, of course, but they've got to be careful because there might be a long-standing tenant. So that's a little bit different. But going back to the auction side of things, what they will do when it comes to the end, because there isn't anybody in the property, it's an investment, it's an asset at the time, they'll be very quick. If you don't pay, we don't see, very, very rarely from my side do we ever see anybody just not paying and then disappearing. I've never had that personally. People are generally, because they've put a lot of money into this, they've generally put a lot of work into it. They're not just going to walk away, I would imagine, unless something really drastic has happened. And it does, of course, we know that. But if they put a lot of work, and generally if you keep, and as long as you're talking to us as a broker or number one, the lender, everybody can work together. There's always generally a route you can work out and whatever. But if you don't, yes, they will repossess, and they'll repossess very, very quickly. So it is a caveat. I might sound it as if it's a little bit scary, but it's not. As long as you have things in place, and bridges are generally very good. They will talk to you or talk to us all the way along the process. how are things going, how are things progressing, especially the smaller bridges who we have great relationships with. How's that going? Okay, if we give them a call and just to see, can we pop round? Especially on development side. Some of the bridges are really, really good. Oh, we're just going to pop down to site just to see. Yes, they're being nosy. Yes, they're in it for themselves, and they want to know that they're not on a Caribbean island, rather than putting windows in the winter. But it's one of those things that it works both ways, and the people, our clients, are usually very, very happy with that, because if you're doing that, generally they like to show off their work, even if it's a refurbishment. Say, look what I've done. Look how good it is. And pretty much it works all round. It really does. It's all about communication.
Yep. So I'm quite glad you brought that round to a positive end again. So we've finished 2 sections on positive notes. That last one was a bit close, mind you, but with the repossessions, but you managed it. Well done. So moving on, I wonder if this third and final section is going to be positive or not. This is the summary of current mortgage rates, and we always look at sort of residentials, standards of buy-to-lets, and then moving into limited company buy-to-lets and HMOs. So going back to the beginning of that then, how are we looking at the moment, Simon, for residential rates?
Residential rates, we have the good news. I am going to bring it around to some good news, because we have a couple of the larger lenders have brought rates down below the 60% loan to value. So it's people with either a lot of cash, a lot of equity to put into purchases or remortgages. It's not going to be for the first time buyer, I'm afraid, but they're dipping below the 4% mark for the first time. So we can celebrate for the first time in a long time. So the 3.98s are out there at the moment. Are they going to drop a bit more? I do believe so. I think it's going to be a busy time for lenders. Certainly working for us as a team, we're getting a lot of inquiries compared to where we have done for the earlier part of the year. Because people are thinking, right, okay, it starts with a 3. Definitely, I'll have a look at it. Now, it may not suit your position and what you're looking at, and you may not have that equity. But the higher up you go, I mean, even if you're at 75%, there's a 4.2% rate out there on a 5-year fixed at the moment. So you're only going slightly over that 4%. I think that's the sort of golden nugget, should we call it, at the moment, the 4% mark. I really do think it's a feel-good factor. Now we're seeing rates go below that 3%. Although saying that, we have had them on buy-to-lets. If you remember, we've had them over the last sort of few months with horrific fees attached to them. So we ignore those. We put those to the side, and let's say just standard mortgage products, standard residential products. If you have the equity there, they're now below the 4% mark, which is just really fantastic. And I'd go on to say, and that's actually filtered down to first-time buyers, because there are more 95% products out there as well for people. So with a lot of listeners, if they're going there and they're looking, and it may be they're obviously investors generally, but if they're looking for nieces, nephews, children, whatever, we're in that sort of realm. It's a lot of people have got 5%, because a 5% is still a lot of money these days. They've got to build that up from the rent they're paying. So, but 5-year fixed rate on a 95, you can get just over 5%, 5.09. That's really good. I think that's really good. Yeah. And I think that will probably come down a bit. So it's a lot of positives there. Really good. So that's the good part. Let's start with the really good side. Not so good is the limited company buy-to-lets and HMOs. They haven't really dropped. Now, I would say watch this space, because it's all with anything with a Bank of England base rate cut. It's always the headline rates which are going to be cut first, because that's where the majority of their money. It's the big banks, HSBC, HSBC have been really, really good. They're great to work with at the moment. So I'm giving a shout out to them because they're really good. They seem to cut their rates really quickly. Barclays, again, very, very good. They're cutting their rates quickly. So I would say they're going to cut them really quick. They'll come down quite rapidly. In the limited company buy-to-let and the HMO sort of multi-unit block kind of world, it's more specialist lenders. They always take their time. So we're probably a little bit early. So there hasn't really been much to talk about there. Your 5-year fixed rates, the best one, 4.49 with a 7% fee. They're still there.
Ouch, ouch, ouch.
And they're sort of, depending on what the loan is, a best buy is 4.99 with a 3% fee. And and again, depends on loan size, doesn't it? Whether that works or not. So they are out there. They're not I will be interesting to see what happens with 2-year fixed rates, because for the last year or so, they've been higher than the 5-year fixed rate. Be very interesting to see when we speak again if that's switched over, because it should do. We'll see how the market is pricing that in then. But HMOs, very much the same. For the HMO investors out there, lowest 4.79 with a 7% fee. Or you could get 6.19 with no fee. So that's very generous. But they haven't really moved. I would say on that one, watch this space. If you're in that marketplace, if you speak to a broker and then and watch it closely, because I do get the feeling they may well come down over the coming weeks. And if the rumours are true, and if we're going then move into the autumn, although we haven't had a summer yet. But if we move into the autumn and the rumours are true, and there's more talk about rate reductions again, it could get. I'm positive it could get really, really exciting, and the buy-to-let market could really start moving again, because it needs to, doesn't it?
Yep. Yeah, definitely. Cool. Fantastic. Thank you very much for that, Simon. Thank you very much for sharing all of your knowledge and experience throughout this episode. And I hope you will join me again in a few weeks-ish time to continue the conversation about exciting mortgages, as you said. And if anyone listening cannot wait that long, then Simon's contact details will be in the show notes. So do have a look there. Do reach out to him. Do get in touch if you have any mortgage questions at all that you would like to have him help you with, including, of course, bridging finance questions as well. And that is really it from me and Simon this time. So thank you very much for listening, and I will speak to you again next time.